All right, so here is the second part of our presentation on traded securities. And so we're kind of picking up. We had just finished oops, there we go. We had just finished the fair value adjustment from December 31st, 2025. And now we're kind of moving through time. And so the next thing we need to record is the sale of the 550 bonds on April 30th, 2026. And so again, as we move forward, we're going to record this sale. Now, we will be doing journal entries related to these 550 bonds that are being sold. But one thing I want to make clear is we're not touching the other 250. So in other words, when we do a transaction where there's a partial sale, we're only dealing with the ones that have been sold. We don't touch the ones that we're keeping. That's one benefit. If you notice when I did my amortization table, I did it on a per bond basis. And when we did the fair value adjustment, we did it per bond first. And so that's one advantage is now I have a per bond number that I can use and apply it to this transaction. And so we're going to record that sale. A couple things just as a reminder. First of all, whenever a debt investment is sold in between interest payment dates, the buyer must pay the seller of the investment any accrued interest as of the transaction date. So those bonds are accruing interest, and in this case, they would have paid interest on December 31st, 2025. When I sell them, the buyer of those bonds does have to pay me for the interest that accrued between January 1st and April 30th, 2026. And so there's a contractual amount of interest that I'm going to be paid as part of the transaction. The other thing is we do need to record any interest accrual. In other words, the interest revenue, we need to accrue that. There's going to be this amortization process that's going to be part of it as well. And then, of course, we are going to do a fair value adjustment for the ones that are being sold. Now, this is probably of all the transactions in this chapter, this is probably the one where I've seen the most variation in the way that it's executed in practice, or in both in practice and in different textbooks. And so in this case, we're going to be doing this transaction in three parts. But ultimately, the whole goal of this, when we think about this transaction, this three-part transaction is, we're going to record the fact, what we sold it for and the amount that we were paid for sure. We got to take the debt investment off the books. We've got to take the associated premium off the books. We've got to make sure that we understand any fair value or any kind of gain through the change in the fair value above and beyond any change attributable to amortization. So amortization of the premium. So we've got all these things going on in one sort of group of transactions. But at the end of the day, that's what we're recording. We're recording the sale itself. In other words, the cash flows related to it. We're accruing interest. We're recording the gain that's related to the sale, and making sure that that gain is after accounting for any amortization for that 4-month period. So again, we're doing it in different parts, and hopefully you see all the parts at the end, and then we'll kind of go from there. So here is where we are in terms of the amortization table. So this sale takes place in between the December 31st, 2025 journal entry and the December 31st, 2026 journal entry. So that process of accruing interest and that process of amortizing the premium is occurring in between these two dates. But again, we wouldn't normally record anything until December 31st, 2026. Of course, now this transaction on April 30th creates the need to update our information and make sure we're correctly capturing the amortization relative to any gain or loss we might have had on the sale itself. And so as we pull those two rows aside and kind of focus in on them, the first step of this three-step journal entry is we are going to accrue interest as of the sales date. And so we're going to do that basically through three different accounts. The first one was going to kind of create, this is a permanent account, but we're going to temporarily create an interest receivable account. Again, it's just a mechanism to get to the end. And so if we had done all this in one transaction, we wouldn't need this account. But because we're doing it in three parts, we're going to temporarily create this interest receivable account. And all it's meant to do is to capture that contractual interest payment. And the idea here is that there was an amount of interest that contractually accrued. If we had held that bond for the entire 12 months, we would have been paid $80 per bond. But of course, we only held it for 12 or for 4 months. And so that purchaser is going to or going to pay us 4/12 of $80 per bond times 550 bonds for a total of $14,666.67. And so that receivable again is capturing that payment that's going to take place. And so when we record the payment, we'll take this receivable off of our books, but it's sort of temporarily capturing it as we walk through this three-step process. The second part of the journal entry is to accrue the interest revenue. And this is, just the economic reality that this $77.62, that is the amount of interest we would have accrued over a 12-month period. But of course, we only held these 200 or these 550 bonds. We only held them for 4 months. So we're only going to accrue that interest for 4 out of 12 months. And so our interest revenue that we're going to record for these 550 bonds is $14,230.33. We do need to amortize the premium. Again, if we had held those bonds for the entire 12 months, the total amortization would have been $2.38 per bond. But of course, in this case, we're only amortizing 4 months. And so we take that full 238 applied to 550 bonds. But again, we're recognizing that we're only amortizing 4 months. And so again, the premium has a debit balance. To amortize that, we need to credit of $436.33. So again, that information that we just calculated, we're just now throwing it into a journal entry. One thing I did to make the journal entry work is I just rounded that amortization up to 437 instead of rounding down to 436. That was just a choice. But again, we're just taking those calculations and then putting them into the first step of 3 of our journal entry. So that's step 1. Again, now what we've done is we've accrued the interest and we've partially amortized the debt investment basically to update the amortization because we need to get to its new carrying value to kind of understand what the real gain or loss is at the time of the sale. All right, the second step. The second step is to record the fair value adjusting entry. This is where I would say there's probably a little more variation. So what we're going to do is we're going to basically create the gain or loss through a fair value adjustment. That is one acceptable approach. I've taught it different ways, but essentially the unrealized gain or loss that we record as part of this entry will basically be the gain or loss that we have as part of the sale. We're just not distinguishing this gain or loss from a normal fair value adjustment. I have seen textbooks that would make that distinction, but in this case, our textbook doesn't. And so we're just going to be consistent with that to reduce any kind of confusion. And so the fair value adjusting approach is exactly what we did before. And the first step in doing a fair value adjustment is understanding what is the fair value at the time of the transaction. And so for this transaction, the fair value was given as 103/4. That was the price. So that tells us that the fair value is 100.75% of the par value, which is $1,007.50. We compare that to the amortized cost. Now, I'm going to tell you the table amount, if we kind of think about the table, is as of December 31st, 2025, the amortized cost was $1,013.85. And if we had held it for a full year, it would have been down to $1,011.47. Of course, we didn't hold it for a full year, but we did partially amortize the premium in the journal entry we just did in step 1. And so we had updated the amortized cost. And so we need to capture that here because again, we're comparing the fair value to the up-to-date amortized cost. And so the updated amortized cost, again, we start from the $1,013.85, again, taken from the table, understanding that we had partially amortized each bond for those 4 months. So a full 12 months would have been 238. We only amortized 4 months. And so there's a partial amortization again with the premium. I'm sorry, with a premium bond, we're bringing the amortized cost down. And so now the updated amortized cost is $1,013.06. That captures if you do 4/12, it's about 79 cents. So that is the updated amortized cost. So the comparison is between the fair value and the updated amortized cost. And so that difference, the balance is that difference. The balance in the account then is negative $5.56 per bond. And as we mentioned before, whenever we calculate that balance, that's not necessarily the journal entry because we have to compare that balance to any prior balance. And so for each of these 550 bonds, there was a prior balance, and that prior balance was negative $3.85. So it went from negative 385 per bond down further to negative 556 per bond. And so the entry amount for this journal entry is a negative $1.71. Now we know journal entries only have debits and credits. So on the next slide, we're going to figure out, okay, does that mean we need to debit the account or does that mean we need to credit the account? So this one is showing the calculation. And then the next slide, we're going to walk through the actual journal entry. Again, this is what we had just recorded at the very bottom of the previous slide. So we know we need to decrease the fair value adjustment $1.71 for each bond. And so to decrease this fair value adjustment account, we need to credit that account. So $1.71 per bond times 550 bonds is $940.50. So now we have an updated balance. And that balance is, if we go back a slide, that updated balance now is for these 550 bonds. I'm going to be very, very clear. For these 550 bonds, there's an updated balance now of negative 556 per bond, which means there's a credit balance for each one of those bonds. But for this journal entry, it's just the change, which is $1.71 per bond. So we're going to credit the fair value adjustment account, which of course then implies a debit to our gain/loss on investment account. Noting that it's we're even though there's a sale here, we are still going to include this unrealized account. We're just not going to make the distinction. Again, other textbooks might make the distinction. I'm just trying to be consistent with our textbook. So then the last step is we have to imagine all the different accounts that have balances that we've got to deal with for this trading security. And so the final piece of this, the third step now is to record the cash receipt and remove all of the related accounts off of our books. And so the cash received, as we already noted, it's going to be the price plus any contractually accrued interest. And so the price again was 100.75% of the par value. The accrued interest is 4/12 of $80 on a per bond basis. And so we are going to receive $1,034.17 per bond. When we apply that to 550 bonds, the total cash that we're going to receive when we sell these bonds is $568,793.50. The next thing we need to do is remove the debt investment. Hopefully that one's not too hard. If you recall, the debt investment is always carried at the par value, which is $1,000 per bond. Again, this is an asset. We're removing that asset. And so when we remove that asset, it's going to be a credit entry to that asset. We're going to remove the remaining premium. Again, we have to think, what was the premium balance? Again, for each of these 550 bonds, the previous balance was $13.85. That's taken from the table. But remember, we had made a partial adjustment to that premium balance for these 550 bonds. And so that previous adjusting amount in total was $436.50. And so in total, essentially, our remaining credit is $7,181.35. Because remember, we'd already partially reduced the balance per bond, and now we're just taking the rest of it away. And then finally, actually two more things. We do need to remove the fair value adjustment account because if you recall on the previous journal entry, we didn't remove anything, we just adjusted it. So now there is a remaining balance in the fair value adjustment account for each of these bonds. Once the bonds are sold, we need to take that account off of the books. And then the final thing is, again, just if you recall, the updated balance for those 550 bonds was 556 per bond. Again, it's a negative amount, which means it has a credit balance. Since it has a credit balance, we need to debit the account in order to remove the effects. And then finally, if you remember on the first journal entry, we had accrued that interest receivable, and I already told you then when we record the payment, we've got to take the interest receivable off of our books, and now we're going to do that with this journal entry. And so we take all of that information that we just calculated and we throw it into one journal entry. And with trading securities in this final journal entry, we already recorded the gain or loss when we recorded the fair value adjustment in step 2. And so there's no need to have another gain or loss here because we've already accounted for it. Now we're just simply reconciling everything and taking it off our books and simultaneously recording the cash that we collected. All right, so hopefully that's not too bad. We're going to do, I think, one more journal entry here just to kind of close the loop on the journal entries for trading securities. So we're going to do that December 31st journal entry. Actually, we're going to do two of them. This one may run a little long. That's okay. But we have the December 31st, 2026 journal entry. Again, we're just moving down the amortization table. Hopefully this one's fairly straightforward at this time. So the cash that we're going to receive is $80 per bond, noting that we had 800, but we sold 550. And so there's only 250 left. And so the cash that we're going to receive is $20,000. Similarly, we're going to accrue interest revenue. Again, we got to just remember we've held these 250 bonds for the entire 12 months. And so we need to record 12 months of interest revenue. And so the total there is 19,405. And for the amortization of the premium, again, we're going to record a full 12 months of amortization, which is 238 per bond for a total of 595. Again, I hope this journal entry by this time is fairly straightforward. And then the fair value adjustment. This is maybe the one that might be a little bit harder, but again, this is now the third time we've done a fair value adjustment. And so hopefully it's not too bad. So we're going to kind of walk through it real quickly. This will be the last thing that we cover on this video. And so the fair value per bond, again, three-step process. Fair value, amortized cost, take the difference, compare that to the prior balance. That gives us our journal entry amount. And so the fair value per bond is 102, which is 102% of the par value, which is 1,020 per bond. We're going to update the amortized cost. Again, this is now the updated amortized cost because we've recorded the adjusting entry. And so we're going to compare those two. Again, the amortized cost is $1,011.47. If we take that difference, the fair value adjustment account balance is now a positive number because the fair value is more than the amortized cost. If you remember in the previous one, the amortized cost was here and the fair value was down here, so there was a negative balance. Now the amortized cost is here, but the fair value is up here, which means now there's a positive balance. And that positive balance is $8.53. But again, remember, whenever we've had a previous journal entry related to the fair value adjustment, the journal entry isn't the balance. This is the balance, but that's not the journal entry. The journal entry is the change in the account. So we need to compare this balance to the prior balance. Now, again, the last time that we made an adjustment to these 250 bonds was on 12/31/2025. At that time, the balance was negative $3.85 per bond. And so that difference then, the change is $12.38. And we need to go from a negative number to a positive number. So we need to increase our fair value adjustment account. So that's going to be a debit entry to our fair value adjustment account. And so if we apply that to all 250 bonds, there's going to be a $3,095 debit to our fair value adjustment trading security account. Take that information, and again, the debit to the fair value adjustment account, and then we're going to credit that gain loss account. Remember, just being clear that we're sort of capturing gains and losses in one account. In this case, it is going to be a gain though, because we're crediting that account. So it's a positive impact on our income statement. But again, we're just using one account for gains and losses just collectively. All right, I'm going to stop there and we will pick up with the financial statements in the next one.